Hello to all value investors, thank you so much for tuning in. In today's video, we will do 4 important takeaways from Warren Buffett and the interpretation of the financial statement by David Clark and Mary Buffett. We will also add in our own reflection from time to time when we think it will be a service to you. With all due respect and no further delay, let us dive in. Thank you. Lesson number 1. In the realm of business is a very competitive world where companies need a strong competitive advantage to survive. This is what Mr. Warren Buffett looks for when he decided to put his capital to work. He built his fortune by investing in those companies that thrive and dominate their industry. There are 3 key points how we can spot such a company. 1. The company is selling a unique product. 2. The company is selling a unique service that is in high demand. 3. The company has the lowest cost in the product or service that is consistently needed by the public. Especially when the company has the consumer's mind. For example, if you want to paint your room, where do you think to go to buy the paint? Most people would pop in their head the name Home Depot. Whichever company that pops in your head is probably the one that has some sort of a competitive advantage over their competition and possess the consumer's mind. The favorite competitive advantage companies to invest in are companies that are selling unique services, and they do not have to spend much on research and development, or spend heavily to maintain their facility to be top-notch in the industry. Such unique companies selling special services have huge profit margins because their expenses to keep the service afloat is very low. A good example would be H&R Block Tax Services firm according to this book. To sum up, lesson number 1 finds a company that has a competitive advantage through being a seller selling a unique product, a seller that is selling a unique service, or a company that is providing the cheapest cost in service or products which is consistently in high demand. Please remember, as Mr. Lynch once said, know what you own and know why you own it. So are you owning a company with a competitive advantage, and does that company possess the consumer's mind? Lesson number 2. The 4 consistency for a competitive advantage. 1. Does the company have a consistently high gross margin? According to a Google search, a good gross margin would be 20% or more. However, please keep in mind that industry varies from one another. 2. Does the company have little or no debt? A good ratio of this is anything less than 0.5 debt to equity. 3. The company does not spend heavily on research and development. The rule of thumb is none is best, or the lowest among their industry. 4. Earnings increase consistently. The competitive advantage company should have a consistent earnings increase of 15% a year. A quick way to look at this by taking the EPS divided by the current price. For example, if the EPS is $1 and the current price is $10, the earning is at 10%. However, we want a 15% increase year over year when looking at a company with a strong competitive advantage. Please note that a crooked company can manipulate their EPS through share buyback even when they are not making any money. A quick way to spot this is by looking at their share buyback and compare it with their earnings, also referred to as net income. If the earnings or net income is not growing or decreasing and the company is still buying back their share, this is a huge red flag. To sum up lesson number 2, consistency is king in the world of investing, and the 4 consistency mentioned can tell if the company of our interest has a somewhat competitive advantage over their competitors or not. Before we move on to lesson number 3, what should we look at in the income statement? Please, if you like what you are seeing so far, may you kindly click that like button below and kindly subscribe to our channel. This will really help us a lot. Without your love and support, we won't be able to make it. We truly owe it all to you. Thank you so much in advance. Lesson number 3. What should we look at in the income statement? 1. We should look at the cost of goods sold, also known as COGS. Compare it with their competition. The lower this cost, the better it is. Of course, the net earning of our company must be par or higher than the competition, while the cost of goods sold is lower. Is a win-win situation for a company of interest. This could mean that our company of interest is more cost-efficient in bringing their goods to the market than the competition's. 2. Gross profit margin. Anything 40% or more can be a good sign that the company has a good competitive advantage in its industry. Anything lower than 30% usually means that the industry is very competitive, or the company is not in a strong position within such industry. 3. Under operating expense. As you can see, there is a tab named Selling General and Administrative, also known as SG&A. Make sure this expense is consistent and does not spike too much. Be careful with companies that vary too much in SG&A year over year. For example, this company SG&A shows us a huge red flag. Their SG&A is almost 300% more than their revenue, and look at how it spiked or dipped from year over year. The rule of thumb for SG&A is 30% or less compared to their revenue is fantastic, but sometimes great companies can have a range of up to 80%. Make sure is not 100% or more as the example above. 4. Again, under operating expense, there will be tab Research and Development, also known as R&D. A company with no R&D is always a better choice than a company that does, because with R&D expenses it could lead to more expenses like selling general and administrative expense. Take 2 companies for an example. Company A is a drug manufacturing company that need research and development to make a new drug. After the new drug is formed or is ready for the market, they have to spend even more money on SG&A expense in order to advertise this new drug. Now let us take a company B, like Coca-Cola, that barely has any R&D cost. The only cost that Coca-Cola incurred is SG&A for advertising and marketing. At the end of the day, the less cost a company has, then the more money it can put in its pocket. As investors or partners of the company in a long run, we can also benefit from their cost saving through dividends or share buyback. 5. Depreciation is very important, since the company needs their equipment or tools to produce their products. Therefore, depreciation should be added to the expense year over year. We all know how Mr. Munger feels about earning before interest, taxes, depreciation, and amortization, also known as EBITDA. Mr. Munger said such earnings are like cow manure. Another word for EBITDA is BS earning. Please remember, don't discard depreciation when looking at the company expenses. For competitive advantage companies, depreciation should be ranging from 5 to 10% a year, taking away from the gross profit. 6. Gain or loss is not a reoccurring event, so any of this number that is reflected in the bottom line should be removed to reflect the real number of the company earnings. For example, sale of property or sale of any assets of the company. If the sale reflects a gain or loss for that year, it shouldn't affect the business as a whole, and it shouldn't reflect the business for the years to come. Therefore, we should not take this number into consideration if there is any under this tab. 7. Income before tax is what Mr. Warren used to determine the earnings power of the company, not after tax, because tax can vary from time to time, but the income before tax should reflect all companies the same way. 8. Net earnings or net income. When looking at this number on the income statement, make sure is an upward trend. As we mentioned earlier, be careful when looking at EPS as an upward trend. Double check if their net earnings are reflected with the upward trend of the EPS. Example of a competitive advantage company net earnings compared with their peers. Let us take 2 companies, Company A and Company B. Company A net earning is $2 million from revenue of $10 million. This gives us the total earnings, or the bottom line profit, is 20%. 2 divided 10, that will give us 20% as mentioned. Now let us look at Company B. Revenue is $100 million, and they are only netting $5 million at the end of the year. Even though the company is generating more revenue than Company A, but its net earning percentage is a lot lower. They are netting only 5% compared with Company A at 20%. As investors, we would rather pick Company A than Company B. Any company that has a net earning of 20% or more is usually the company with a competitive advantage.
Just a quick reminder from payingforward.net: if you do well in life, or when you do well in life, please seek ways to pay it forward to others that are less fortunate than us. Direct giving is what they believe in, especially toward the abandoned children of the world. Thank you.
Lesson number 4. The balance sheet and the cash flow statement. Under the balance sheet, we will find two main categories. One is the assets of the company, and the other is liabilities. In both of these categories, there are short-term and long-term liability, or current and non-current assets. For the short-term, liability is debt that is due within a year, and for the long-term, liability is debt that is due over a year. For current asset is any possession that the company can easily liquidate to extract cash within the year. And non-current asset is any asset that is not easily liquidated. This usually takes more than a year to extract any value of cash. In order for us to get the net worth of the company, we must subtract the total assets to total liabilities, then we will get the net worth of the company. In other words, shareholders' equity is the same as the net worth of a company. If we zoom this down on a personal level, we would want ourselves to have a positive net worth instead of a negative net worth. Therefore, when we look at the company's net worth, it will be wise to select those that have a positive net worth as well. Here are a few keys to look for when looking at the balance sheet. 1. Cash equivalent section. If there is any in this tab, we would like to see the number piling up from year to year is a good sign. When it piles up, this means that the company is generating a lot of cash. One time piling up is a sign that the company sold part of their business or bonds, and this is a bad thing, something to pay attention to. A rule of thumb for this section: if a company is sitting on a lot of cash and barely any debt, is usually a good sign that this company has some sort of competitive advantage. However, if the company is short on cash and is in a lot of debt, this is what we should avoid. 2. Receivable section. When looking under this tab, we would like to take the net receivable and compare it with the gross sale. Make sure this number is lower than the gross sale. A gross sale is a number that reflects the grand total of all the sale transactions within a certain period for the company. And, to get the net receivable, we would have to take the total receivable amount and minus with the allowance for doubtful accounts. As you can see here from this illustration, allowance for doubtful accounts is bad debt that we don't think the client will pay us back. When minus bad debt with the total account receivable, we should get net receivable. Please note it is very difficult to find the gross sale of the company, so in this case, we should use net sales, also referred to as total revenue of the company, instead. 3. Inventory. We already covered this section in another video. This section is very important, and we will leave the video on the end screen. Thank you. 4. Current assets can be used to get the current ratio. A current ratio equal to current assets divided by current liabilities, and anything below 1 is something to be careful with. Anything above 1 is good, but the range should be 1 to 2. However, some companies with a very good competitive advantage could be below 1. If this is the case, make sure we look at their net income or earnings to see if the company is in good health. 5. When looking at goodwill, if we see it increase year over year, this means that the company is acquiring other businesses. This can be a good thing if the company is purchasing competitive advantage companies. 6. When looking at long-term debt or liability, little or no long-term debt is a good sign that the company has some sort of competitive advantage. The rule of thumb is little or no long-term debt is a good long-term bet. 7. Short-term debt. Be careful with companies that borrow a huge sum. We would recommend investors be careful with companies that have more current liability than their current assets. 8. Long-term investment is carried on the asset side of the balance sheet. This number can reflect management thinking. Are they investing with the capital that is generated by the company? If they are, and if they invest in other companies with a competitive advantage, this is a good sign. 9. Preferred stocks is usually a sign that the company is not in a competitive advantage arena, because great companies do not need to finance more capital since they are already generating so much capital. If any company that preferred stock, watch out for. 10. Retained earnings is an accumulated number. When a company generates profit, this profit reflect in the retained earnings and growing year over year. If the company loses money, then it will reflect in the retained earnings as negative or in brackets. Only rare occasions where retained earnings are negative in a competitive advantage company. Please remember this is one of the most important section in the balance sheet. If the retained earning is not growing, then their net worth is not growing, and if that is the case, it won't get us far with our investment. 11. Treasury stock. When looking at this tab, it will show us that the company is repurchasing their share, which is a good sign. However, there can be financial engineering in some cases. 12. Return of shareholders' equity. Mr. Warren usually prefers 30% or more. Net earnings or net revenue divided by shareholders' equity will give us this percentage. Rule of thumb is to be careful with a company that shows both negative in shareholders' equity and net earnings or net revenue. Now we will move on to the cash flow statement. 1. Capital expenditure. As mentioned earlier, not having it is always a good sign. As a rule of thumb, a company that used less of their earnings on capital expenditure is better than those that have a huge sum of their earnings in this tab. Net earnings or net revenue of 50% or less go to capital expenditure is usually good companies with a competitive advantage. Track this history through 5 years to 10 years records. 2. Stock buyback. We can find this under cash from the cash flow from continuing financing and under net common stock issuance if you are using Yahoo Finance. If you are using MSN Money, it will be under cash flow from investing activities and under the proceeds or issuance of common stocks. Stock buyback is a great sign that a company is doing very well and they are buying back their share. When a company does this, it helps to raise the price of the stock, making it worth more. 3. Free cash flow is very important for this number. It should be positive and grow year over year with competitive advantage companies. This number reflects the cash that is generated after all operating expenses and capital expenditures are covered. According to Mr. Peter Lynch, free cash flow is the most important number to look for when looking at the cash flow statement. If you would like to have access to free intrinsic value calculators, please visit our site at valuesnet.com for free intrinsic value calculators. Thank you so much for your time and attention.